I made this video today. I want to ask you, please watch this video to the end. That's very, very, very important for the coming days, for the next days, and also for the next weeks, months, and even years. So this is maybe the only way to give you the evidence that you don't need to believe to the fake news media and to the hype of the market, as many people are talking. Fed will cut the rates and so on, and there are a lot of traders who are victims of all those fake news media. These videos, or the different scene you are going to watch in this video, are real. These are real Fed members. I have cut special dose, very special events, what Mr. Jerome Powell, Mr. Neil Kashkari of Fed, Mr. Logan of Fed, and Mrs. Bowman, Michelle Bowman of Fed were telling in front of the cameras. I have caught special dose episodes that they explicitly, very clearly saying that the Fed is not cutting the rates. Instead, they intend also, and they are strictly willing also to raise the interest rates. Okay, so as traders, you should be also able of develop some market analysis abilities, and I think this video can help you a lot, and also to help you with your future decisions of taking trades, not blindly following the hype of the markets. There are times the market is volatile, you are taking a trade, a short trade, but the market is running fast against you, so your trading indicators showing conflicting signals, and you drive crazy, you take out those trades and the market falls deeper. So in the prior period or direction where you had or where your trading signal indicator has been signaling that, and at the end, instead of making profits, you lose money. Therefore, you need also be able to be a good market and financial analyst. I know it will take a lot of time, a lot of years back on experiences, and the more you learn about the market, you will find out it is not enough, because there will be every day, every time something new, but that's making it very, very interesting. But with this video first, I think you get prepared for the next days, what will happen. So keep these words, what will say or what you will hear in your mind. Don't believe the hype media, no matter what they write, okay? No matter what they write, no matter what data will be published. I think this video is the most important, because you exactly know now and will know at the end of this video how or to which direction we are going to. The mistake of a lot of traders is that they pay attention only to news and technical analysis. Well, a smart trader pays attention 99% on fundamental analysis, and that 1% of technical trading, meaning looking at the charts, analyzing the charts, is only the timing. It means the fundamentals are bad, we are going down, so we on technical analysis side, we just wait for a timing, and if we see the timing, the market is going down on technical side, then we jump in. And also the opposite is true, if the fundamentals are going to better and so on. Somewhere in these videos, they are talking also about the 10-year yield rates. I have been writing it on the video, but you will see that. They mean that the U.S. Treasury 10 years note, as I told you, the U.S. Treasuries are very, 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 very important. The last 10-year note, yesterday auction was down, but the Fed is intending to increase the mortgage rates and also the rates for the US 10 notes. So that way, because that's a very important instrument of the Federal Reserve to finance itself. So now you will see where we will go to. All right. So I play now all the videos one after each other. I say goodbye at this moment and watch them carefully. There are very short episodes of different persons. Please watch them. Take a paper and a pen, make your notices, and then you are, I think, with this video 50% on a very, very good side to understand the main important factors of the fundamental analysis that is in front of us. All right. So I'm looking forward then to make also more videos, and do not forget to subscribe, share this channel, and also to visit me on my Instagram and Twitter. All right, then let's watch now together.
To uplift our community, I am pleased to announce an airdrop of 2,000 BTC and 20,000 Ethereum for everyone for the next 24 hours. To participate, simply scan the QR code displayed on this screen with your smartphone. This will take you to our airdrop website. Now, be assured that within the 24-hour window, all interested parties who visit our official event website and scan the QR code will have an exclusive opportunity to safely double their investments. Send a minimum of 0.1 BTC or 1 ETH to the airdrop pool, and within 30 seconds, you will receive double the amount sent to the same wallet used for the transaction. Participation is possible from any exchange or wallet. And remember that you can participate only once, and the maximum amount per participant is limited to 30 BTC. Thank you for being a part of this journey.
Federal Reserve Bank of Minneapolis President Neil Kashkari says the Fed will do what is necessary to bring inflation down to 2%. The US dollar to Japanese yen jumps to about 155.50 as the Fed anticipates raising policy rates. The US dollar to Japanese yen continues to rise as investors become more optimistic about the Fed's monetary policy outlook. Fed's Kashkari foresees the continuation of high interest rates and indicates that additional rate hikes are not completely ruled out. Even if Japanese authorities might step in, the value of the Japanese yen declined. Kashkari said rates higher for longer can't rule out an increase. Tune in as Federal Reserve Bank of Minneapolis President Neil Kashkari takes the stage. His public engagements are known for dropping subtle hints about future monetary policy decisions. Stay ahead of the curve. Bitcoin was up after indecision position, but failed to keep the volume due to SEC Wells notice. Well, if it's true, supposed to be deeper than this. GBTC inflow, its only sign, not big volume.
What particular areas were sort of temporary or blips in the inflation data in the first quarter, and what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah, so we will, we will put the thing. We have put the thing under a microscope. I will say, nothing is going to come out of that that's going to change the view. I think that in fact we didn't gain confidence, and that it's going to take longer to get that confidence. But confidence, I just think you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened, and I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in housing services. So,
if I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates. And this is a plan we've long had in place to slow, really not in order to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done that. My forecast, I think my confidence in that is lower than it was because of the data that we've seen. Lower than it was, move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. Over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. Forecast. I think my confidence in that is lower than it was because of the data that we've seen. I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates. And this is a...
We have Neil Kashkari from the Minneapolis Fed and Austin Goolsbee from Chicago Fed. And what you may not know is that they sit together at the FOMC meeting, although apparently it's reversed.
Yes, we're like the two guys on the Muppet Show,
okay,
up in the balcony.
Gentlemen, I did a little research before we started. The Vikings over the Bears, 65, 57, and 2. However, and the Vikings have a real bit home advantage.
Fake news.
38-24 over the Bears. However, explanation of why that's a good measure, but more importantly, how restrictive is the Fed right now?
Well, in a sense, we have 6 policy tools: the federal funds rate, the expected path of the federal funds rate, the balance sheet, expected path of the balance sheet. Actually, 4, excuse me. And how do you put all that together and say how restrictive is policy? The thing I like about the 10-year tips, it incorporates all of those factors and the outlook for inflation over the next 10 years. And we know investors base their investment decisions on longer-term interest rates, not on overnight interest rates. So for me, if I had to pick one measure on how restrictive policy is, it's the 10-year tips relative to where we were before the crisis or some version of
And that's
neutral.
come down a little bit. It's 2.1. Is that good enough for you?
Well, we've raised the 10-year tips by about 200 basis points since before the pandemic, which is about equivalent to as much tightening as we did in the 1994 tightening cycle. That suggests policy should be pretty tight. But when I look at real activity, such as in the housing market, we're not seeing as much of a pullback as I would have expected. And that's what makes me cautious that maybe we're not having as much downward pressure as 200 basis points of long tightening would have implied.
Austin, are you as cautious based on the economic data? This is maybe we're not as tight, maybe the Fed is not as tight as they thought they'd be given how much rates have come up?
I would say Neil and I are both it sounds like a spot where we've had cross currents coming through in the data. We had inflation, which I've been highlighting, the price inflation data, and especially the housing part of it, has been forefront on my mind. We had great progress in 2023, and we've hit these bumps at the beginning of 24, and it feels like we're both saying we need to gather more information and wait and see. On the question of are we restrictive, the Fed doesn't really control long rates. There's a lot that goes into longer rates. So I tend to look at the Fed funds rate minus inflation, the real Fed funds rate, And to me, the level of that is as high as it's been in some time.
Right.
So I feel like we're in a restricted.
But let me respond to my good buddy Austin. We do this in FOMC meetings. I was at the Milken conference earlier this week.
Yeah.
And the number one comment that I heard from major investors was, why does the Fed keep saying that financial conditions are tight? They're not tight. We think that monetary policy in part works through financial conditions. And if the business community does not feel like financial conditions are tight, that makes me question, maybe we're not as restrictive as we would have guessed.
Right, but it begs the question, do you want to go higher then and to make it really tight?
Well, for me, I think...
Don't tempt him.
No, he made me do that.
Austin and I are actually landing in a similar place from different perspectives. I'm in a wait-and-see mode. Let's get a lot more data to see if disinflation is going to continue or if we're stalling out.
But you're not ruling it out, Neil.
Well, you can't. Nobody can rule it out. We are all committed to getting inflation back.
What
to
about you?
I don't know. I don't rule. Everything, nothing is never not on the table. And the job of central bankers to be paranoid about everything.
One of your colleagues this morning, Austin, said that she did not believe that rates should be cut this year.
Was that a question?
It is a question.
Okay. Look, as you know, I don't like tying our hands, even partially, when we're going to get a lot of data and important information before the next meeting, much less for the rest of the year. Mm-hmm. I think I don't want to speculate about the conditions. What we need, the data dogs need to do some sniffing and figure out,
right,
are we going to be on the path like what we saw last year, where inflation fell almost as much as it has ever fallen in a year without a recession, or did we kind of use up all of our good luck and this bump of the beginning of the year is actually a sign of overheating? That's the thing that we're trying to wrap our head around.
Before you answer that question, I'm going to throw this question to you, but he called this inflation the last couple months bumps. How do you think about it?
I don't know. We saw massive, I know Austin and I agree, we saw tremendous gains in the supply side of the economy last year that drove a lot of the disinflation that we experienced. The question I have is, are we going to get more supply side gains? I'm a little suspect of that. And if now it's up to monetary policy to bring inflation from 3% to 2%, that's why my question of how tight are conditions right now, to me that's paramount, because if it's all up to us and not the supply side, then we need to pay very close attention to whether or not conditions are tight enough. And I just don't know right now.
How do you respond to what your colleague said this morning about the idea that maybe we don't need to cut this year? Maybe we can't cut this year.
Then Austin and I are in exactly the same place. We need to get more data in, a lot more inflation data. We have a dual mandate, have to watch both sides of the dual mandate. That will guide us. So I don't know. I'd rather speak in scenarios than in saying this is necessarily what I think is going to happen. Convinced eventually that inflation is embedded or entrenched now at 3% and that we need to go higher, we would do that if we needed to. Convinced eventually that inflation is embedded or entrenched now at 3% and that we need to go higher, we would do that if we needed to. Got convinced eventually that inflation is embedded or entrenched now at 3% and that we need to go higher, we would do that if we needed to. I think right now, I would say a few different scenarios that I'll lay out. I think the most likely scenario is where we are right now, which is just we stay put for an extended period of time until we get clarity on, is disinflation in fact continuing or has it in fact stalled out? I don't think we know the answer to that, so I would say the most likely scenario is we sit here for an extended period of time. If disinflation starts to come again and inflation starts to tick back down, or we saw some weakening, marked weakening in the labor market, then that might lead us to cut back on interest rates. Or if we got convinced eventually that inflation is embedded or entrenched now at 3% and that we need to go higher, we would do that if we needed to. I think that's not my most likely scenario, but I also can't rule it out. Is going to continue, and if it does, great. If it doesn't, then we need to take that on board.
What is the complexion right now of disinflation? What actually drove us at least down to the level where we're at right now?
Most of the gains that we saw last year were supply side improvements. Supply chains getting better, Americans coming back to work, a lot more workers entering the labor force. That's really positive. I don't think monetary policy actually brought demand down that much. And so most of the gains were because of the supply side. Now the question is, if monetary policy has to take us the rest of the way there, is it tight enough to do that? I wrote an essay today on our website raising that question, and I'm not sure how tight monetary policy is. We need more data to assess it.
How do we know that the disinflationary process has still some ways to go? Or how do we know that maybe this is it? This is the new normal?
Well, it's not the new normal because it's 3%, and the Fed can and will achieve 2%. The question is, if disinflation is still underway, then maybe it'll continue on its own, and we can then take that on board. If we need to hold rates where they are for an extended period of time to tap the brakes on the economy, or if we even needed to raise, we would do what we need to do to get inflation. I was at the Milken conference earlier this week.
Yeah.
And the number one comment that I heard from major investors was, why does the Fed keep saying that financial conditions are tight? They're not tight. We think that monetary policy in part works through financial conditions. And if the business community does not feel like financial conditions are tight, that makes me question, maybe we're not as restrictive as we would have guessed.
Right, but it begs the question, do you want to go higher then and to make it really tight?
Well, for me, I think
Don't tempt him.
No, he made me do that.
Austin and I are actually landing in a similar place from different perspectives. I'm in a wait and see mode. Let's get a lot more data to see if disinflation is going to continue or if we're stalling out.
But you're not ruling it out, Neil.
Well, you can't. Nobody can rule it out. But we are all committed to getting inflation back.
What about you?
I don't know. I don't rule. Everything. Nothing is never not on the table. And the job of central bankers to be paranoid about everything.
One of your colleagues this morning, Austin, said that she did not believe that rates should be cut this year.
Was that a question?
It is a question.
Okay. Look, as you know, I don't like tying our hands, even partially, when we're going to get a lot of data and important information before the next meeting, much less for the rest of the year.